All right. Time for some coffee together, or maybe you've got tea. I'm going to have a sip of espresso right now and wait for you guys to arrive. I see some people in there. I see Crit Powerit says, good afternoon, Crop Master Stotz. Yes, happy to be here. I just 5 minutes ago, I was on the back of a motorcycle on my way back from a wedding, and that was really cool. So Pizit Pong says, I'm eating lunch. Okay, that's good. I didn't have my lunch yet. Usually Mondays are my fasting day. But welcome, everybody. We're going to be talking about the all-weather strategy and taking your questions. But hopefully you're relaxing with a cup of coffee, some food, or a cup of tea. I went to a church on near Soy Convent, and it was a very nice church. And my mom and I went, but I had to leave my mom there because I had to be on this call. So I left my mom there. She's with all the girls from the wedding, and she's happy because it's her caregiver who got married. All right, let's get started. I'm going to open up my presentation and go through some points here. So let me do that. Hold on. I'm going to go to the presentation. There we are. All right. So this is a review of the August performance. This is the 9th of September, 2004. So remember to ask questions. I love all your questions that you guys bring me. So our allocation strategies are global, and they're long-term, and they're diversified. And I like to always remind ourselves, why are we here? We're here to build wealth over the long term. It's a long period of time that we've got to stay invested. Now, there's 6 pillars of investing that I think are most important for this long march that we're on. First is invest in stocks, because they've returned much more than bonds and gold over a long period of time. Plus, owning a piece of a company means you get a portion of what the management team creates. Gold doesn't create anything. Gold is a non-yielding asset. It's not bad, and I think it's fine to have in a portfolio, but the core investment we want to do is stocks. Second is to reduce risk. You want to avoid overexposure to any single asset by spreading your portfolio across various sectors and companies and asset classes. That's what we do. And contribute regularly. Reduce stress by applying dollar cost averaging consistently, investing a fixed amount over time. And that takes advantage of volatility and likely lowering costs and enhancing your long-term returns. Number 4 is stay invested. Think long-term. Be patient. The benefits of compounding happens over decades. Maintain discipline. Follow your investment plan to avoid acting based on emotion. And continue learning. Deepen your understanding of investing and stay informed about market dynamics, and refine your strategies by learning from successes and failures. So we create our strategies for many decades, but not even really a decade is long-term. This is me almost 60 years ago. This is me when I came to Thailand 30 years ago, and this is me when I'm 100. Our aim is to create strategies that perform over many decades. Now, I outline a lot of my thinking in the book, How to Start Building Your Wealth Investing in the Stock Market, which is available in Thailand in both Thai and English. So our target is to deliver steady returns over the long run. Here we can see the performance of our 3 portfolios. AWS was launched in February of 2019, and we target 6%. Alpha Focus, the blue line, was launched in October of 2021, and we target 8%. And All Weather Inflation Guard was launched in July of 2022, and we target 4%. So let's look at all 3 of these strategies since the inception of All Weather Inflation Guard in July of 2022. We can see that All Weather Alpha Focus is just above the moderate risk AWS. And AWIG has had the lowest return, but also very low volatility, and that's our goal with this one. So all strategies had lower volatility than world equity, which we can see here. Now we mix asset classes to try to avoid market drawdowns, which you could see happen in 2022. Our strategies didn't go down. But that also means that we missed market booms. Not only here, but also if I grab my pen, I'll highlight, we also have missed this market boom. But I'm okay with missing the booms as long as we miss a portion of the busts. So let's look at our strategies. All-weather strategy was flat for the month. Here we can see since inception, the strategy was up 45.5% and 15.4% above a 60-40 portfolio. In August, the strategy was flat, which was 1.6 below the 60-40. As you can see, did very well. Our 25% allocations to gold and developed Europe did well, while our 25% target allocations to Asia, ex-Japan, ex-China, was a drag on performance. And I'm glad that we didn't have our overweight position on Japan like we've had in the past when we had gotten into Japan. Luckily, our exposure to Japan is minimal. So Japan and China still, though, account for about 5% or 3% of the portfolio. Now, all-weather Alpha Focus had a great month. It was up 1.9%. It's important to remember that all-weather strategy and all-weather Alpha Focus uses very different strategies. So here we can see the strategy was up 4.2% since inception and about 6.4% above the 60-40 portfolio. And it's about 1.2% below world equity, but with a lot less volatility. You can see, again, the world equity line, the green line came down quite a bit, but we didn't come down like that. And we have reduced our equity allocation to 68%, which leads to a lag as world equity rose. Here we can see strategy was up 1.9%, which was about 0.3% above the 60-40 portfolio. And our big tilts to healthcare, infrastructure, gold, and bonds did well. The main drags on the performance were the world equity fund and a 3% allocation to energy. So now let's take a look at all-weather inflation guard, a lower risk strategy. Here we can see since inception, it's up 8.7%, and it's 5.2% above a 40% equity, 60% bond portfolio. It's also had less volatility, as you can see in the red line. So the strategy was up 0.6%, which was 1.1% below the 40% equity, 60% bond portfolio, which we consider our benchmark. Global bonds were strong in August, and our 10% allocation to gold did great. But our 5% target allocations to world energy did poorly. As you can see, world energy got hit quite hard. Now, why is world energy going down? Well, I think part of it is that the market or investors are expecting a slowdown in the economy. And when the economy slows, oil price tends to fall. All right. So before I go any further, I'm just going to skip back. Welcome everybody here. And I'm going to come out of this. Hold on. There we go. So I want to welcome everybody to this event, which I try to do every Monday. Hopefully you've had a cup of tea, a cup of coffee, or your lunch. And I'm going to be answering some questions now before we go back into the presentation. So feel free to ask any questions that you may have. All right, let's look at the first question. So let's see. John Pence says, I've reallocated the port AWS as recommended since Friday morning. Is it the right time? I think it's fine. I wouldn't worry about it. From my perspective, all weather strategy, we've just rebalanced the strategy. And so this is the right time from a perspective related to rebalancing. It's going to have its ups and downs, which is fine. It just, you have to, that's why I try to help people think long term. So I think it's fine. All right, another question. SK Specialty 43 says, although Fed will decrease interest rate in September, why recession concerns are coming back? Well, I think that first thing is that how did the U.S. avoid a recession? One way they avoided a recession is that the government printed a lot of money. They spent a huge amount of money in America, trillions of dollars. And it's very possible that the impact of those trillions of dollars are starting to wear off, and that there's not much more that the government can do to stimulate. The second thing is high interest rates slows down economy. And so that's another concern. And at about this time last year, I was telling you that I think the economy is going to come down in fourth quarter, and we're going to go into a recession. But luckily for America, they've been able to hold off this recession. But I think that eventually that recession is coming. So yeah, there's still recession fears, and it's being reflected in interest rates coming down. Let's see. Healthcare is a great choice for gaining the portfolio. Yay. All right. Good afternoon, Supergone. Good to see you. Let's see your question. AWS increased U.S. equity, which means you see U.S. will outperform again after September correction. Can you share the reason behind? Well, I think the first thing is that we're already seeing the market starting to anticipate a reduction in interest rate by the Fed. Lower interest rates in America will cause the U.S. market, tends to cause the U.S. market to perform. So you can say the anticipation of further interest rate falls is one of the things that gets us into the U.S. The second thing is if I think there's a very real possibility that the U.S. Fed has to cut interest rates pretty dramatically. And that's only going to happen if the market starts to fall or if the economy starts to fall. And if that's happening, generally that's very good for stocks. So part of the anticipation not only is interest rates coming down, but that we're going to see a potential rally in stocks if the U.S. interest rates come down more than people plan. Supergone says, again, can you share your succession plan after you retire? Hopefully you'll continue to work more than 15 years. My succession plan is, I don't have a succession plan right now. My feeling is the good thing about the strategies at FINNOMENA is that if something happens to me, then you just have your portfolio with the funds that we've selected or I've shown you and you've selected. And then you got to decide, do you follow another guru or do you do it on your own? And that's going to be up to you. But there's no real risk to you if something happens to me. Now, the only downside if something happens to me is that you've got to, you won't have me to follow anymore. It's possible that my team could continue that. We have a whole infrastructure of what we do. But for right now, I wouldn't say that I have a strong succession plan with someone coming in. So my succession plan is to stay healthy. Salaya DC says, how long and how bad will the recession be? In theory, I think it could be bad, but I also believe that the Fed, everybody wants market manipulation through central banks. If things go bad, they expect that the central bank is going to come in. And so I think that that's what would stop the recession from being really bad, is that the central bank would come in and spend a lot of money to prevent it collapsing. And that means that it won't be as bad as what people think. All right, let me go back to the presentation. And I like those questions, so please keep those questions coming. And I'm going to come back to the questions in just a bit. All right, so let's go into the global outlook that guides our asset allocation. Global inflation has come down. We can see it here. and central banks are battling inflation while trying to avoid a severe recession. Now, this particular data I've taken from a bottom-up analysis of every country in the world weighted by its GDP. And what we can see is that interest rates are not really falling that much around the world. So the 3-month government bond yield was fallen to 5.5 from 5.9 a year ago, very tiny. And probably most of that was driven by the US. So we haven't seen US interest rates come down by much. And even when we have, it hasn't had much of an impact globally at interest rates coming down. So rates came up quickly. Inflation has come down. Rates have fallen a bit. And I expect continued lowering of interest rates. Now, the market has started to expect faster and steeper cuts from the Fed. In fact, we can see here, I would argue that this is a factor of global economic weakness. And combine that with geopolitical conflicts, and we are defensive with our equity allocation. So for the past year, we've said that we think the course will eventually reverse. I still expect central banks will reverse course and return to accommodative policies as soon as something breaks. Now, we're already seeing them turn to accommodative positive policies, which tells you, okay, eventually I'm right on this. But the point is that I think there's I think there's more to go as far as the Fed reducing interest rates. The massive rise in rates will eventually break something. And when the news turns negative and markets start weakening, I expect Fed to reverse course and bring rates back to zero. A no recession scenario appears to be priced in, which constitutes a risk if the Fed fails. So here we can see global bonds bringing diversification benefit. The correlation to world equity has fallen recently, which makes it even more attractive right now. Now, the Fed has held rates high for a long period of time. We're about to pass a record of 15 months, which is an incredibly long time to keep interest rates high. That chart is since I graduated from high school. So we're talking about a long time. So assuming we're at the peak in interest rates, the Fed has held the rate at the current level for 14 months. Only building up to the GFC has the Fed held the peak rate longer, and just by 1 month. The market is certain that the Fed will start easing in September. So here we can see what's priced into the market. Everybody now expects the Fed to reduce. By how much? Well, at least reduce. The amount is, depends. But falling rates typically have an expansive effect on the economy. And we think global bonds could benefit from falling interest rates because the bonds in the portfolio are earning a much higher return. So only Bank of Japan is expected to raise rates slowly, but still extremely loose monetary policy there. We have high allocations to global bonds in all three strategies. Now let's look at oil prices. They've moved sideways to down. The global growth outlook has worsened, and we expect demand to soften. And more importantly, when it comes to oil and energy, countries are trying to make those items more expensive. The conflicts in Ukraine and the Middle East could lead to supply shocks and push up oil price to a peak. So let's look at the global economic growth outlook, which I think remains uncertain. I still think the main upside in commodities would come from a supply shock and adverse weather conditions or significantly higher demand due to improved growth outlook. We currently don't have any allocation to the commodities fund in any of our strategies. Now, central banks have loaded up on gold. Maybe they're switching from dollars into gold. The central bank demand from the total demand from central banks and other institutions was almost as great as in the 5 preceding years. That's incredible. We expect central bank demand to remain strong. Now, Gold protects value in times of uncertainty and market downturns. It's been quite a ride for gold. It's typically a safe haven in times of geopolitical tensions and financial turmoil. Rising government debt in major economies can raise concerns about credit quality and stimulate the gold price. In other words, gold does well in bad times, and in good times, it performs poorly. Now, gold does have strong momentum, so we're seeing a lot of people moving into gold. Based on the previous mentioned reasons, gold has gained momentum. So before I go to asset allocations, I'm going to come back and just see if we have any questions out there. I see a question from Chipia who says, hold on. You said a recession in the U.S. is coming, but why you suggest S&P? Because I believe that the reaction to the recession will be to lower rates and pump money into the system. Because I think that Americans don't want to lose anymore, and they think that the Fed is going to save them. And so if the Fed does save them, then we need to ride that Fed wave. Supercorn says, how do you consider duration in the bond fund you selected? Ideally, I want long-term bonds. I don't want short-term bonds, but occasionally I'll get into those short-term bonds. But duration, because I'm not active fund manager right now when it comes to this strategy, I'm implementing it. And I would say that the bond fund duration, really, I'm just looking for the best bond fund that I can find. Now, the best bond fund I can find right now is the global bond fund. I am considering to create a bond fund, but that means that I can't really switch duration that easily. So what does it mean? If you think interest rates are coming down, you want to be long duration in your bond portfolio because those bonds are more volatile. And so if I was only a bond portfolio analyst or fund manager, then I would be lengthening the duration of my bonds in anticipation of the market falling and ultimately interest rates falling. Let's see. Gal says, do you think the current Fed cuts have priced in a bit too much than we expect, that we can expect some repricing? I personally think that the U.S. is going to go into pretty strong recession. And if the Fed's going to need interest rates to be back to zero. So I don't have much problem. You know, what I'm watching the Fed do is start talking about reducing rates, but eventually it's not going to be a choice. They're going to be forced to reduce rates to prevent things from going bad. All right, let's go back to our presentation. So let's look at our new allocations. Let's start with all-weather strategy. Here you can see we've reduced equity to 50%, and we're increasing bonds to 25%, and we're keeping gold at 25%. And we've reduced Developed Europe and Asia Pacific ex-Japan, ex-China fund, the fund that we are helping manage. We've exited commodities. And we've changed the U.S. equity fund. The new fund has the same master fee fund, but charges a lower fee. So it makes sense for our U.S. exposure to use that one. Now, the U.S. market is typically resilient. Even though the U.S. is facing many challenges, the market's typically considered safer than, for example, emerging markets. During market turmoil, capital typically moves towards the U.S. The U.S. also appears stronger than other developed markets like Europe and Japan. We increase our target allocation to 25%. Still, around 65% of MSCI World is the United States. And that's a huge allocation. Now, ECB may pause its rate cutting due to concerns about sticky inflations. At the same time, rising unemployment and lowering manufacturing PMI signals a weaker economy, which would call for rate cuts. Developed Europe has failed to convince when it comes to tackling the economic challenges. And we're now allocating just 5% to Europe from our previous 25%. Though the US-China conflict can lead to relocation of production to Asia ex-Japan, the region produces many essential commodities and loses from low or falling commodity prices. And as we reduce our overall equity valuation, we reduce the target allocation to the region. Let's look at all-weather alpha focus. Here we can see that we're staying with the current equity positions at 68%, and gold at 19%, and bonds at 13%, and 0 to commodities. So we've exited energy and financials, and we've added 3% to precious metals, miners, and India, respectively. This gives a picture of the new strategy. A growing old population supports strong demand for healthcare. We can see that according to this projection, by 2020, the population above 65% old is expected to have grown by 800,000. That's an incredible number. Let's look at the demand for care and drugs, which is independent of economic conditions and cycles. Medical procedures that were delayed during COVID now drive demand along with other things. Given a more defensive equity outlook, we keep our target allocation to 70% in the defensive healthcare sector. And then there's infrastructure. They've been benefiting from from environment, green energy security after other infrastructure spending. Typically, they produce cash flows and is able to push through costs increasing from inflation. So now let's look at infrastructure fund that we're using. It's got heavy exposure to energy and energy transition. Global electrification and AI trends require energy, and long-term demand should remain strong for energy. We keep our target allocation at 17%. And that wraps up all-weather strategy. Let's look at all-weather inflation guard. We've raised equity to 30%, and we reduced gold to 5% and 5% to REITs. And also, we're exiting commodities. So let's look at the performance. Financials, I expect to benefit from a more stable rate environment. While interest rates might be lowered, they're likely to remain high for a while, which should benefit the earnings of financials. Financials could start closing the gap since the U.S. regional bank crash in mid-March 2023. Now, at least one thing is different this time compared to the late 20s, and that is that many of the big tech companies are producing quality profits. These companies have high return on invested capital and strong balance sheets, and quality stocks should do better in an environment of high interest rates. Let's look at another one of our positions, Infotech, which you can see it's driven the market. The momentum driven by the exposure, the positive AI sentiment can continue and keep a 3% target allocation to this world Infotech. So here we can see Infotech driving the market, and we got 5% in global REITs. Remember, we don't do global REITs in all-weather strategy, but we can in Alpha Focus. They're good inflation protection, as many leases are tied to inflation or adjusted based on inflation. And some say REITs benefit from lower interest rates, but the relationship is not obvious. With that said, all else equal, lower rates means lower borrowing costs and higher property values as the discount rate falls. It also increases the relative attractiveness of REITs compared to, for example, bonds. The master fund has the largest exposure to REITs, especially industrial REITs. Residential REITs should remain strong amid growth and growth in rent. Healthcare REITs are generally defensive, and data center REITs, are doing very well. And then there's low office REITs. So it's time for Q&A. Remember, in fact, we're starting our next boot camp. It's going to be number 18 because number 17 is starting today. We have 130 plus people, and this one starts on November 4th. These are some of our students that I was able to see just recently. The Valuation Masterclass Bootcamp, you get a 6-week guided, intense online valuation program, daily live sessions. You write and present a professional valuation report. So if you want to save $100 on this, just click on the link or scan the QR code, and we'll see you there. All right, I'm going to open up for questions. Okay, let's see. Let's see what you guys say. Hold on. Okay, we did that one. Let's see the next one. Supergorm, what's your view? EQ, ET, cause, economic, not same as what happens in the past. Not sure what EQ, ET means, I must admit. If you can clarify that, that would help. Chalom Pat, in AWS allocation, what is the difference between you have 5% in Asia Pacific and 5% in emerging markets? What's the difference? Well, remember that emerging markets is Latin America, Eastern Europe. There are many emerging markets outside of just the big large caps. So that's what that is. ABB says, John Andrew, yes. Okay. Chayapon says, Gong Naman Nalong. See, my Thai is so bad. Minecraft. Laka. Yeah, better not for me to. But what I would say is that when we go into an economic slowdown, which I think we're going into right now, oil price tends to come down substantially. And so it could be that we're just in that process. So here's a link that you can click on. And then when you do, you can use FINNOMENA as your code. Okay. Let me get this one up here. So you mean QE and QT. I think we're going to go into a significant QE event where there's going to be a huge amount of borrowing and spending by the Fed. So that's what I think. All right. Any other questions? Boy, we went through the material pretty fast tonight. Let me know if you have any other questions. As you can see, I've been up since about 4 a.m. I'm a little sleepy, but I'm happy to be here. Any other questions? All right. I want to thank everybody for joining. That was a short session, but without any other questions, I think we're okay to end it there. Feel free to ask your advisor, ask FINNOMENA, or ask myself further questions anytime. I hope that you have a great day ahead, a great week, and I'll see you in 1 month.